Without utility companies, we don't have a society. Many people don't realize the complexity and fragility of our public infrastructure, but these systems are what utilities focus on every day. These businesses provide services like water, electricity, or gas distribution to the public. Although these are private, for-profit companies, they're part of the public infrastructure and heavily regulated. Utilities rely on expensive, heavy infrastructure to deliver their product and often require large debt loads to fund this continuous investment need. As a result, during periods of higher interest rates, utility companies could experience hard times. In the 70s and 80s, with its steep interest rate hikes, many utility companies faced huge debt loads, rising energy costs, and bankruptcies. Utility companies that made it through that period enjoyed strong growth thereafter and are poised to succeed in future high interest rate environments. The Green Initiative is also expected to boost the performance of utility companies, with the Investment and Jobs Act earmarking $65 billion for power infrastructure upgrades and $369 billion for tax incentives that will reduce the cost of the renewable energy transition for utility companies. Utility companies are well known for consistent dividend payments, with many companies paying an increasing dividend for over 50 years. Every month, Dividend Radar publishes a spreadsheet of dividend champions, contenders, and challengers. Challengers are companies that have raised their dividends for 5 to 9 consecutive years, contenders for 10 to 24 years, and champions for over 25 years. This resource is a great way to screen companies that have paid consistent dividends over many years, but further analysis is often needed to see if a stock on this list is worth buying. Today we're going to take a deeper dive into utility companies on this list and see how they compare. If you enjoy this content, make sure you hit the like button and subscribe to the channel for future videos, and make sure you turn on notifications to get notified every time we release a new video. To rank these stocks, I pulled 10-year historical data for each utility sector challenger, contender, and champion. When comparing the stocks on this list, I had a few criteria to keep in mind: dividend yield, dividend growth, length of dividend increase, dividend growth rate of change, payout ratio, net income growth, free cash flow growth, operating income growth, and earnings growth. For details on how I score stocks for each category, check out my stock ranking deep dive video on my channel. Number 5 on our list is UGI Corporation with a score of 63.46. UGI provides natural gas, liquefied petroleum gas, electricity, and renewable energy solutions to customers in the United States and Europe. UGI owns 5 subsidiary companies: UGI Utilities, Mountaineer Gas Company, UGI Energy Services, UGI International, and AmeriGas. UGI was actually the first public holding utility company in the United States, founded in 1882 in Philadelphia. UGI has paid dividends for 139 consecutive years and has consistently raised its dividend for the past 36 years. UGI currently yields a 4.3% dividend with a 10-year growth rate of 7%. This growth has remained fairly stable over the past 10 years, with the dividend growth rate of change only barely declining at 0.85% per year. UGI's payout ratios were very safe, with the 10-year aggregate payout ratio coming out to only 40.4%. All 10-year average payout ratios remained below 55%, indicating the dividend is very safe and has ample room to grow. All this impressive dividend data is offset by less than stellar financial growth. Net income grew by 7.4%, free cash flow declined by 6.9%, operating income grew by 2.9%, cash flow by 0.28%, and earnings by 4.54%. UGI offers an attractive dividend with extremely safe payout ratios. The length of dividend history and impressive dividend increase streak indicates to me the company values investor returns and will continue to pay an increasing dividend. The weak financial growth is something to keep an eye on, but given UGI's long history and dividend metrics, this company looks like an excellent choice for a long-term investor. Next on our list is California Water Service Group, ticker symbol CWT, with a score of 64.14. CWT provides water and wastewater services to over 2 million people throughout California, Hawaii, New Mexico, Washington, and Texas, each with their own subsidiary company. California Water was founded in 1926 and most recently founded Texas Water through 4 acquisitions in partnership with BVRT Utility Holding Company. California Water currently offers a 1.8% dividend yield with a 10-year growth rate of 4.7%. Nothing to write home about, but California Water Group has raised their dividend for 56 consecutive years, making them the first dividend aristocrat on our list. We can expect this dividend to grow rapidly as their dividend growth rate of change is a staggering 24.8% over the past 10 years. CWT's 10-year aggregate payout ratio comes in at 78.9%, just at the edge of what I would consider safe. Upon closer inspection, all payout ratios have 10-year averages below 57% except for that of free cash flow. Over the past 8 years, CWT's free cash flow numbers have been negative, pushing the aggregate payout ratio much higher than the other averages. California Group's financial growth has been steady, save free cash flow, with net income growing at 9.1%, free cash flow declining at 20.9%, operating income growing at 3.5%, cash flow at 6%, and earnings by 7.6% annually. This steep decline in free cash flow indicates heavy investment in capital expenses like new infrastructure or materials to keep the business growing. This should be expected in a utility company, but it's something to watch as the quarters go by. CWT is a near century-old company with very strong dividend growth. I haven't seen a company with a dividend growth rate of change anywhere near as high as 25%. This strong growth can offset the low initial yield over the long term. Since the payout ratios are all very low, save free cash flow, and the company has been raising its dividend for 56 years, I expect the dividend to be very safe for the foreseeable future. The declining free cash flow is a little concerning to me, though it may also indicate stability and lower maintenance costs in the future. Evergy sits number 3 on our list with a score of 65.06. EVRG provides energy distribution services to 1.7 million customers and founded by combining Great Plains Energy and Westar Energy in 2018. Evergy has put heavy emphasis on sustainable, non-carbon energy infrastructure and expects to be carbon neutral by 2045. EVRG currently yields a 4.1% dividend with a 6.1% growth rate. Like California Water Group, this dividend growth should continue to increase at its historic rate of 10% per year. Although Evergy is only 5 years old, the dividend history of its constituent companies put their dividend increase history at 20 consecutive years. Like other utility companies, Evergy's free cash flow payout ratios have been high, but 10-year average ratios from net income, earnings, operating income, and operating cash flow remained below 70%. EVRG has had strong financial growth, with net income growing by 14.6%, free cash flow declining at 12.1%, operating income growing at 10.9%, cash flow at 11.6%, and earnings at 5.1%. Evergy seems to combine the benefits of the previous two companies into one. It has the attractive initial yield of UGI Corporation coupled with the increasing dividend growth of California Water Group. Like most utilities, EVRG's free cash flow is low and even negative during some years, but this is to be expected given the capital-heavy nature of the utility business. Mix this in with strong financial growth along all other measures, and you have a solid energy company with a bright dividend future. Number 2 on our list is Black Hills Corporation, BKH, with a score of 66.49. Black Hills provides electricity and natural gas services to customers throughout Arkansas, Colorado, Iowa, Kansas, Montana, Nebraska, South Dakota, and Wyoming. The first Black Hills was formed in 1883 as Black Hills Electric Light Company and has merged with many other utility companies over the years, finally founding Black Hills Corporation in 1941. Black Hills currently owns 6 subsidiary businesses, including Black Hills Power, Wyodak Resource, and Enserco Energy. Black Hills offers a 4.1% dividend yield with a 10-year compound growth rate of 5.1% and a dividend growth rate of change of 7%. BKH has been increasing their dividend for an impressive 53 years. The payout ratios of Black Hills are consistent with that of other utility companies, with high historical free cash flow ratios and all other ratios sitting below 82%. Financial growth has been strong with net income growing by 15.7%, free cash flow declining by 21.1%, operating income growing by 5.6%, cash flow by 1.3%, and earnings by 10% annually. BKH has a long corporate history to complement their impressive 53-year dividend increase streak. The initial yield is very attractive, and the growth is expected to continue to increase. As long as BKH is able to maintain stable payout ratios into the future and continue its strong financial growth, I see Black Hills as being a safe and lucrative pick for any dividend investor. Lastly, with a score of 67.5 is SJW Group. This company provides water and wastewater services through subsidiaries in California, Connecticut, Maine, and Texas. SJW currently owns and operates 39 water treatment plants, over 400 wells, 5 wastewater facilities, and more than 300 water storage facilities, just to name a few. The vast majority of their net income comes from their California and Connecticut subsidiaries, making up over 86% of their total business. The dividend yield of SJW currently sits at 2% with a 10-year growth rate of 8.4%, the highest on our list. The dividend growth rate is also increasing at a 7.5% annualized pace. SJW is tied for the longest dividend increase streak at 56 years, making them the 18th longest dividend increaser on the stock market. Excluding free cash flow, the payout ratios for SJW are extremely safe, all averaging below 62% for the past 10 years. Financial growth has been steady, with net income growing by 6.4%, free cash flow declining by 20.1%, operating income growing by 5.1%, cash flow by 8.1%, and earnings by 0.9% annually. The current dividend yield for SJW is a little lower than I would like, but makes up for it with extremely strong dividend growth that's expected to increase. The dividend history and low payout ratios indicate the dividend is safe from financial turbulence and has plenty of room to continue its growth. This, coupled with consistent financial growth, makes SJW an excellent choice for a conservative investor interested in security over total return. Thanks for watching this video. If you found this information helpful, please give us a like and consider subscribing to the channel and leave a comment to let us know what you think. As always, stay safe and take it easy.